Okay, welcome to part two of bonds and the term structure of interest rates. Last time we talked about what bonds were, how they were priced, and we ended on how longer term bonds had more risk associated with them, and thus there was a higher interest rate. We're learning a little bit more about that today. And so what's known as the term structure of interest rates. And it's pretty important stuff in understanding how monetary policy operates, especially in 2008 when interest rates were at zero, and during COVID when, they were still at zero. These are really two bouts of what's known as unconventional monetary policy. And we'll get into that a little bit later. There's a little bit more you guys should really learn about, like the fundamentals of money and monetary economics before we really get into um, the zero lower bound stuff and unconventional monetary policy. So, if longer term bonds tend to have higher interest rates with them, um, what if we were to look at interest rates on bonds of different maturities? So these are assets of like the same like class, so to speak. It's just the maturities are different. And if we ordered them out such that we went from the yields on the shortest to the longest, what would we see? Well, we'd expect to have some kind of an upward sloping curve where short term yields are lower than long term yields. This is what's known as the yield curve, and it reflects the term structure of interest rates. And we generate it using interest rates on bonds of different maturities during a particular point in time. That could be within like an hour, a day, a month, whatever. If we wanted to look at yields to maturity for US Treasuries between 2000 and 2015, this is what we would see. So if we're going from the 3-month all the way up to the 30-year Treasury, you can see that the shorter the maturity, the lower the interest rate. And then as we go into higher maturities, we tend to see higher interest rates. Now, if we were to plot out the yield curve, so what is this relative to this? Well, that over here, let's see, so I got one for 2015, and that's what's in blue here. It's a pretty nicely behaving yield curve. Well, that would be, I don't know why I said 2015. It's actually like 2024. Oops. Anyways, so that would be if I took this point, this point, this point, this point, this point, and this point, and then just plotted it out. That is the yield curve. And that's this right here. Now I've got yield curves for different years. I really just took the average for 2014, 2015, 16, blah, 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 all the way on. Now, a year is relatively informative, but when it comes to looking at these things like, like financial markets, they tend to look at this stuff over the course of like an hour or a day or something like that. I'm not particularly interested in data of that high frequency. But I really just wanted to give you guys an idea as to what the yield curve looks like. So generally speaking, we tend to see lower yields on shorter term assets, higher yields on longer term assets. And they have varying slopes. You can see some of them have pretty similar slopes, like 2015, 2016, and 2017 all have pretty similar slopes here. But then if you look at 2019, it's a little bit flatter. And if you look at 2014, it's a little bit steeper. So either way, when the yield curve is behaving like normally, it's upward sloping, indicating that we've got these longer maturity bonds that are riskier than short maturity bonds. And in order to be induced to want to buy a longer term treasury, investors are going to need to be compensated for taking on that additional risk. And it's not always a default risk. There's also the interest rate risk that we had talked about in the previous lecture. So we can see they all sort of have an upward trend, unless things aren't going all that well. Now, when the economy is about to go into a recession, we end up with something that's known as a yield curve inversion, where longer term yields end up being lower than shorter term yields. And sorry about that. In business cycle macro, a yield curve inversion is seen as a leading indicator of a recession. And we'll talk about why that is towards the end of this lecture. Now, there's a couple of theories regarding the yield curve. There's the expectations hypothesis that says bonds of different maturities are perfect substitutes with one another. So it's like saying, hey, whether you want a 3-month or a 10-year treasury, you're essentially indifferent because, well, they're perfect substitutes. There's the segmented market hypothesis, which says that bonds of different maturities aren't substitutes at all. And there's a liquidity premium theory that says bonds with different maturities are imperfect substitutes. Basically, the expectations hypothesis plus uncertainty, where longer maturity bonds are considered to be riskier or less liquid than shorter maturity bonds because their prices can fluctuate a lot more. So we'll talk about all three of these in pretty decent detail. I don't want to go too far into this stuff. I just want you to really know what it is. I don't want to spend a lot of time doing the math on it. There are way more important things that we can do math on. And to be honest with you, I'm not like one of those talking heads on Bloomberg or CNBC. I almost said a bad word here. I almost said a really wordy word there. And, well, it's probably for the best that I didn't say that word. Anyways, expectations hypothesis tells us that the yield on a long-term bond or long maturity bond is the average of the expected yields on shorter maturity bonds. So if you consider like a 1 and 2 year bond, the yield on a 1-year bond's 4%. You expect yield on a 1-year bond a year from now to be, say, 6%. Then the yield on the 2-year bond should be the average between 4 and 6%, which is 5%. So the yield of maturity is 5%. Now, why is that? Well, if you buy 2 1-year bonds in succession, your yield over that 2-year period is approximately 10%, given by, well, you got 1 plus 0.04 plus 1 plus 0.06. So you're just adding the yields to 1 for each of these, multiplying them together, and you get 0.1024. Now, it's supposed to be 1 plus 0.1024. That was an oopsie on my part here. So if the 2 and 1-year bonds are perfect substitutes, the yield on the 2-year bond has to be the same. And it's driven really by demand and supply. So if you expect future short-term yields to increase, it's going to lower the expected profitability of long-term bonds presently, which reduces demand, drives down the price, and drives up the yield. So the current long-term yield then tells us something about expected shorter-term yields. Now, this is driven by demand and supply. And if you expect future short-term yields to increase, it's going to lower the expected profitability of long-term bonds in the present, which then reduces demand, drives down the price, drives up the yield. We kind of talked about this a little bit. Actually, I think it was like those exact bullet points we talked about. So the expectations hypothesis can be used to infer the market's expectations of future short-term yields. And this is done by using the present yields of bonds on different maturities. These are what's known as forward rates. I'm not going to make you guys compute these, so don't worry about it. Now, the expectations hypothesis can help us make sense of a few things. First, long and short-term rates tend to move together. So if current short-term rates are low and people expect them to stay low, then the long-term yields will also be low. They'll be higher than the short-term yields, but they'll also be relatively low. And this tells us why there's like a flattening or an inversion of the yield curve and how that can predict recessions. And it's that if people expect the economy to go into recession, they expect the Fed to lower short-term interest rates in the future. And if short-term rates are expected to fall, long-term rates will fall relative to current short-term rates, and the yield curve will flatten. So if the economy is about to go under, it's about to tank, it's not uncommon to see a yield curve inversion in advance. And according to the Federal Reserve, a yield curve inversion has predicted the last 10 recessions since 1955. So it's relatively reliable information there. So I plotted out a couple of inverted yield curves. And this is what they look like. Again, the slopes are sometimes really kind of relatively flat. Some actually have a little bit of a downward trend to them. But when the yield curve begins to look like this, it's probably a sign that we're going to be going into a recession sort of soon. Now, if you're like, why did you pick these years? Well, I picked 2000 because there was a recession. 2007, we went into a recession at the end of 2007. 2019, well, we know what happened the next year. And 2023. So if you're like, why did you put 2023 up there? We're not in a recession. Well, we could be. Maybe not yet, but we could be going into a recession soon. So, yeah, really just kind of not trying to paint too bleak a picture here for you guys, but I did kind of want to give you an idea as to what we're looking at. Now, the expectations hypothesis fails bigly. Namely, why yield curves are almost always upward sloping, because if interest rates are mean reverting, then the typical yield curve should be flat and not upward sloping, which isn't the case. There's the segmented markets hypothesis. This is the second one. The idea of this is based around heterogeneity of households, that households are all different. So some households may like longer maturity debt, some prefer short maturity debt. And an idea behind this could be investors trying to match maturity to their retirement horizons. And it could result in higher yields on long-term bonds in equilibrium. So the theory says interest rates are set by a simple supply and demand for the bonds based on segmentation of the markets and not because there's a relationship between interest rates themselves. Thus, bond investors would have like preferred maturities or habitats where they'd want to buy bonds. And according to this theory, bond yields would be operating independently of one another. Think of that what you will. Now, there's liquidity premium theory, and this one is a little bit more convincing. The segmented markets hypothesis doesn't tell us why interest rates of different maturities tend to move together, or account for why you can predict future short-term rates from long-term yields. The liquidity premium theory basically takes the expectations hypothesis and then adds uncertainty in there. So here, the bonds of different maturities are substitutes, but they're imperfect substitutes. And why would they be imperfect substitutes? Well, the idea is that long maturity bonds are riskier. So if they're going to bear some interest rate risk where bond prices fluctuate, savers would demand compensation for taking on that risk. Now, there's a relationship between short and long-term bonds given by this guy right here. And essentially what we have is in magenta, we have the expectations hypothesis. And then in that cyan or the light blue, that's the liquidity premium. It's also what's known as a term premium. And this theory is commonly referred to in a lot of monetary policy research, especially with unconventional monetary policy. So really what I would take out of the liquidity premium theory, because we will end up talking about some unconventional monetary policy that relies on the liquidity premium theory, it's that bonds of different maturities are imperfect substitutes with one another. So short and long-term bonds aren't perfect substitutes. So it's not like you're like, okay, well, all of a sudden the yield on one or the price on one moved one way or the other, and I think I want to go towards the other one. Now, it's not quite that simple. Now, during the financial crisis of 2007 and 2008, the Fed engaged in large-scale asset purchases where they bought a lot of long-term treasury bonds in hopes of trying to flatten out that yield curve. And by flattening out the yield curve, the Fed was able to drive investors out of the long-term bond markets and into other asset markets instead, which would then help spur economic recovery. The idea is that because these guys are imperfect substitutes, there are other substitutes that investors could go towards instead. So they essentially get driven out of the long-term bond markets and then go into equity markets instead. So like you'd see the S&P 500 increase a little bit after monetary policy of these types, because what it's doing is it's pushing people out of these long-term bond markets. Now, if they were perfect substitutes, if short and long-term bonds were perfect substitutes, that wouldn't work because of that liquidity premium that we have. So yeah, that wraps up bonds and the term structure of interest rates. Again, I'm not an expert on the term structure of interest rates. I don't pretend to be. So I really didn't want to focus too heavily on this. There are other things I think that we can spend more time on, but it's important that you understand that there is a relationship between short and long-term bond yields, and that there are different theories of why that is. I guess I should really say if that is, because the segmented markets hypothesis doesn't really consider that there's a relationship between bond yields of different maturities. So that wraps up this lecture. Thank you for watching, and there will be more coming in the future. Bye.